Well, hello and welcome. Welcome to our first in our new series, What They Didn't Teach You at School. The idea of these webinars is to share some information, some insights, some tips, some practical tips and takeaways that you can apply in your affairs so that you can get on top of your own financial affairs and plan for the long-term future. Today's topic is personal cash flow, how to handle your money at a personal level. Whether you're a business owner or an employed individual, we're going to discuss today a whole range of topics to make sure you're handling your money in the best way possible. And we will probably throw in a few war stories along the way for you to learn from so that you don't have those situations in your own affairs. Joining me today, I have Simone Murad from Business Depot Financial Planning Sydney. Welcome, Simone.
Thank you, John. Great
We
to
have
be
Megan Kelly. She's also from Business Depot Financial Planning in Brisbane and also head of Superannuation here in Brisbane. Welcome, Megan.
Hi, everyone.
And of course, Mitch Hood, who's recently joined Business Depot, is one of the directors of Business Depot Financial Planning here in Brisbane. Welcome, Mitch.
Thanks, John.
Of course, whenever we talk about anything related to financial planning and financial advice, it is important to note that hang on, I need to put this up because it is a very important matter. Important to note that anything we talk about here today is general in nature and nothing should be taken as specific to your situation. And you should absolutely always seek advice customised to your needs, customised to your particular circumstances. I'd like to highlight within there that, so we've got our disclaimer there around the general advice, but of course the best thing to do is in anything at the end of this, if you've got any questions, reach out to us and ask any questions that you may have. We'll be more than happy to advise you where we can. Of course, today is a live webinar. You may be watching this as a recorded webinar afterwards, but during today's session, more than happy to take any questions, more than happy to take any comments. If you could please preferably use the Q&A section below. That's a lot easier for us to manage rather than the chat, if that's all right. Okay, well, let's get into it. And I suppose with a topic of personal cash flow, one of my key comments that I'd make about personal cash flow is it's something that I find people don't talk about enough. I find that people talk about their business a lot. I find that people even talk about investments a lot. But sometimes it's just that personal cash flow considerations that I find people rarely consider. But I always remember, Megan, I'm going to start with you with a question if you don't mind, but I always remember someone once saying to me that they feared coming to see me as their accountant more than they did going to the dentist. Megan, if you don't mind, do you think people approach personal finances with that same amount of fear?
Yeah, and I think it comes from just being that bit uncomfortable about whether they're doing the right thing with their personal finances. I mean, at school, no one's ever actually taught you about money or how to budget your personal cash flow. So it does create that fear when you feel unsure about something or like you're not fully in control of it. Most people have really, they just don't know if they could be doing better than what they're currently doing with their own money and their own finances.
And that's it sometimes, isn't it? People want to make sure they're not leaving something on the table, that there's not an opportunity they're missing out on.
Yeah.
What about for business owners? Do you think they need to look at their personal cash flow, I suppose, in a different way to, say, a salary and wage earner? Megan?
Yeah, definitely. I think business owners have a lot more to consider, and they tend to look at the business cash flow and then stop there, if they even do that. A lot of people just sort of, still handle cash flow by feel. Like, I feel it's going well, and not really looking at how it's actually going. And just taking the money when it becomes available and not really mapping it out. So whereas the salary and wage earner sort of knows that the next pay cycle's coming through regardless of what's actually going on in their business. Whereas, yeah, so it's a big difference between a business owner and a salary and wage earner. Yeah.
You've mentioned there some feelings, and I suppose my first question to you was about fear. If I could throw to you, Mitch, I mean, there must be a fair bit of sort of human nature or psychology around how people approach their thinking around personal cash flow.
Yeah, completely, John. In my experience, first and foremost, it's a comfort zone thing where people feel uncomfortable perhaps talking to, relevant family members or friends about money. And that's just perhaps a part of the DNA that we're all brought up to not talk about money. Back, around the house, family roast, not the topic or subject that normally comes up. And for that reason, I think people just need to be open to talk to their trusted advisors or family members about what money means to them and actually start the conversation early rather than leaving until you're retired.
I like that question. What does money mean for you? And it probably even links. I know there's an ad at the moment. It's like, why does money matter? And I really like that sort of theme. But that psychology and that byproduct of the past, I don't know whether you agree with this, Simone, or you see this in your clients, but I often see people get to a later stage in life and almost default to what they were like when they were a teenager and their financial situation when they were a teenager. Do you agree with this sort of psychology around finances and cash flow?
Yeah, the psychology of money is a really interesting topic. And I think that depending on how we've been brought up and our different experiences with money really plays into the way that we treat money now, and I think really it's important to know that with thinking about money and psychology, one way doesn't necessarily work for everyone. I mean, everybody's different. The approach is different. You might have a details type person who wants to really get in and understand every little thing that's going on and every small category. And then you might have a big picture person, and then buckets might work for them. So like a bucket for, or a percentage for housing expenses, or, a percentage for sort of variable expenses might work better. So it definitely is an interesting concept around, our views around money and psychology, and one way definitely doesn't work for everyone.
We've got to take that fear out of it, don't we? We've got to give them comfort and transparency so they've got clarity of what they need to do. So whatever works for them. I mean, I want to labour on that point a little bit, and I'll stay with you, Simone, if you don't mind.
Sure.
I always remember my mum and dad had jars of money above the oven. I remember pre-kids for me, we had envelopes and we had a bit of cash in there, whereas now we sort of have multiple offset accounts against home loans and different things alike. I mean, what are some of those practical tips, I suppose, do you give people to manage their personal cash flow or to avoid traps, I suppose?
Yeah, that's it. And I think one of the biggest tips I would think is to set some time aside to really think about setting a personal budget, understand where your money's going, really sort of look at, okay, what's happening every month, what's happening every week, understand where it's going, and because it's really important to know where your money goes. And it's interesting that you say about how your mum had jars on the fridge, because I remember seeing my mum write out her budget on envelopes and put it near the table and just looking and thinking, okay, that's how she's planning it out her money and how she's paying for everything. Yeah,
and she used to go in and get the cash out to pay the electricity when it came in, and I know it's really old school, but it really hasn't changed, has it? It's like you have a bucket. Mine now is an offset account, and it's a matter of how much is left in the bucket at the end of the month or at the end of the period that it relates to.
Yeah.
Well, after that, John, there's a very successful campaign that we all got hoodwinked in as children called Dolomite.
Yeah.
It was our favourite, childhood dream to have take that $1 or $2 to school every day and actually put it in the envelope to put in somewhere. So
it was a good habit, wasn't it?
Great habit, absolutely.
Yeah. But in talking about budget, we're sort of talking from a slightly different angle, aren't we? Because we're sort of talking about how much do you need to put in the bucket? I suppose that's your budget. And then how much are you spending out of the bucket, and therefore what have you got left? I suppose with that whole process, and many of us do that for our businesses, but Mitch, if I can stay with you, what's a practical tip you would give people as to how to go about that budgeting process?
Yeah, for sure. Well, first and foremost is not to resist it. It's a comfort zone thing. So accept it's the one thing we need to do. If you're going to make bread, you need to buy the flour and the yeast. You can't run and expect to get a result without first going back to the foundations around cash flow. So number one, you've got to do something about it. Number two, if you get stuck, which a lot of clients get stuck on, well, I don't know what to spend money on. And we might sit there with some meetings and talk to them about and give them a list of things that they spend money on. We talk to, and it's never an exact science. It's always an approximation. But just go back over maybe the last 3 or 6 month statements be it online or through, you know, paper-based, if that's what people are still using, and actually identify what you're spending money on, and you'll soon enough form an outcome as to what you are spending money on that you can start to use as your template to actually get the result.
So what I'm hearing there is it's no different to business. Know where you are now, know where your money's going, and then set yourself a bit of a target so that you could get there.
Outside like a business would be one of the cornerstone foundation comments that would have with clients is if a good solid business wants to actually work on this, not once a year, they want to work on it consistently. That's what we should do at home as well.
Yeah. Megan, what would you say from a very practical perspective around this budgeting process?
Oh, I'd say be realistic and honest with yourself as well about what your spending habits are. If you're someone that's not very good at controlling your spending, then putting everything on your credit card is probably not going to work for you because you're not going to pay it off at the end of the month, sort of thing. And that's why the jars analogy is so interesting for me, because we've gone into a cashless society. So I think more and more people aren't really taking note of where that money's gone because we're just so easy to tap your card and move on. So it's about, you know, taking stock of what your habits are, taking stock of what your partner's habits are as well, because if you're using joint money, you need to look at it jointly as well and be on the same page. And then just mapping out a bit of a plan and really holding yourself then accountable to that as to how you're actually spending this money.
So there's a lot of free services available through your internet banking these days that sort of monitor where you're spending your money. And I know you can go in, you can categorize it and that type of thing. Do you guys suggest using those, Megan?
I think, yeah, it's a really easy place to start. They're not perfect. You need to put a little bit of effort into it. But, you know, I know we do it for when we go to do our tax at the end of the year and we go to check how much we've spent on different expenses that we know are deductible, is we just jump in, pull our credit card down as a CSV file and sort it into categories, because it's just, you've got so much information that you can get from your internet banking. So use it, make it easy on yourself, just categorize it, a simple Excel spreadsheet. I am an accountant, I should say that as well. So I do like my spreadsheets. It's an easy way for you to track your money. Yeah.
It sounds like just start by looking at where you're actually spending the money. That might create the desire for change or the dissatisfaction of how much you're saving at the moment to actually then create some new habits. Speaking of habits, and I suppose the contra of habits, Mitch, if I can go to you, you know, people make mistakes with cash flow. Give me, I don't know, we can all learn from other people's war stories. So tell me, when can it go horribly wrong, or what are some of those common cash flow mistakes?
Look, probably the biggest one you see with business owners or even mums and dads that are employed is this idea of negative gearing and the idea of spending money to save money on tax. It can be a false paradise if it's not treated properly. So really understanding the relationship to what the investment is one might have and what that's bringing in as an income, and not just looking at the negative gearing as I want to save money on tax. Tax is a byproduct of what, you know, if you're paying tax, you're making money. And so that relationship with the ATO is going to be a never-ending beast. And just making sure you don't get out of kilt with what your position is around negative gearing would probably be one of the bigger things I see from time to time.
I mean, negative gearing, you actually have to put your hand in your pocket to pay for some of these expenses. Obviously, there's depreciation in that, but you know, paying $1 for a 47-cent tax deduction doesn't always make sense unless there's some other value to add to that. What about you, Simone? Right. What mistakes do you see?
Some of the mistakes that I see is that when people get off to a really good start, but then they don't stay on top of it. So it's not staying on top of it is one of the mistakes that I see. I think it's important to review the cash flow on a regular basis. Look at the way that you are reviewing your cash flow and just make sure that it's working for you. Keep on top of it, be it weekly or monthly, and just make sure it's a priority, because when it's not a priority, that's when we start to see things, things go wrong, and then maybe things are missed, and that's when cash flow goes awry.
Well, if you give things attention, then they tend to improve. But if you don't give them any attention, they've got no chance, do they?
Yeah, that's right.
Megan, common mistakes you see with cash flow?
I guess I see the two extremes. Like I see the people who focus on saving, and they're really quite good at it, but then they forget what they're saving for, so they don't feel like they can ever spend that money. So they're probably missing out and not enjoying their life now. And then I see the people who never plan for the future. So I guess it's really about being clear on what you want to spend your money on and feeling like you can spend your money on it. So setting those goals. A simple example is just planning for changes in your life. You know, my kids are at primary school at the moment, but we want to send them to a private high school. So we need to know that in, 4 years' time that we've got enough cash flow to fund that without impacting our lifestyle too much. So how are we going to do that? And what does that mean with everything else we've got going on?
So it's no different to business strategy really then, is it? And, thinking about where it is we were going to go and what are those roadblocks we're going to come up against over time.
Yeah.
Mitch, you mentioned negative gearing is one of the common mistakes you see in people not providing for it. That reminds me of a client who used to always come in once a year to get their tax return done. And every year they'd come in and they go, oh, I didn't earn that much money, John. I don't have any of that cash. And this particular client that I'm thinking about is a real estate agent. So they've got a bit of a lumpy sort of income. Actually, I might go to you, sorry, Simone, rather than Mitch, if you don't mind. What would you suggest, Simone, around managing those lumpy cash flows like that?
Yeah, look, I mean, when you've got whether it's a business or whether you are an individual who's working and having a lumpy cash flow, I think it's important to treat your cash flow like you are a business owner. You need to look for long-term planning, understand where the peaks and troughs are going to be, know what your expenses are if you're an individual, and know what your working capital requirements are if you're a business owner. Once you know what those items are, then you can actually plan, make sure that there's a buffer, so you've got enough cash set aside for the times where you are waiting on a commission or you are waiting for some payments.
Yeah, I mean, when you've got these lumpy cash flows, I always say to real estate business owners, you've got to provide for the rainy day. I suppose it's no different for the individual sort of employed agent as well. Mitch, what would you say with regards to that, or maybe even from the perspective of what's different for a business owner rather than an employed salesperson in that lumpy cash flow situation?
Look, observation only would be they don't have a plan, so they're spending what they earn, which is not uncommon. If one earns $100,000, they earn $1 million. They tend to find a way to spend it, unless there is a plan about what savings they want to generate. So having that plan is crucial. Also the tax. So far too often business owners can get stuck on not allocating tax. The tax man's part of the relationship. So making sure that with their accountant, they're dedicating funds. If they are the type of person that likes to take draws, making sure they've allocated, because they're kicking the can down the road effectively. No problems with that. There's strategies to why people would do that, but not relying on the fact that you've got this big lumpy tax bill that's going to completely shred your cash flow plan for the coming 6 months. That's probably the big one.
Okay. Anything you'd add, Megan, from a lumpy cash flow perspective?
Yeah, I think, the business owners, lumpy cash flows is part of being in business, and knowing your business and knowing when it's coming is good. I think a lot of business owners are getting better at mapping out that cash flow within a business, but that's probably where they stop. They don't sort of go that next step and go, well, what does this mean for my personal finances? So a great example of that is I've got a client who wanted to invest in their business in a bit of a growth strategy, which meant, basically bringing in another employee, which would reduce the business profits, which effectively reduces what they can take each year. And they hadn't really gotten their head around just what that impact would be. Yes, the whole growth plan was, it takes time to onboard a new employee. So there was a bit of investment in that training and growth till they actually hit that next level of growth. So sometimes just being aware that your business growth plans might mean your personal income has gone backwards for a period of time. And just how are you going to handle that personally and within your, family life? Yeah.
I know if I was talking to a business owner and they were doing that situation, I'd probably calculate their break-even point. If you're going to increase your cost, your break-even point goes up. Do you think it would be a good idea for someone to know their personal break-even point, how much they're sort of committed to or how much they usually spend every month? Maybe Simone?
Yeah, look, absolutely. I think a personal break-even point is really the crux of what we're trying to get at with cash flow. So, you know, when we're looking at your inflows and then we're looking at your outflows, that net cash flow is really that sort of break-even point. When you're in a positive position, that's where you're at. So, you know, when we think about pulling that all together, we're looking at what types of income have you got? Is it employment income or maybe business income? Do you have some investment income as well? You know, what sort of passive income might you have to add to that cash inflows, and then where are your expenses, where's the money going, you know, and then coming to and you've got your net cash flow out of that. So that's really your personal break-even point. Yeah,
if we link it back to that individual with a lumpy cash flow, then striving for some passive income so that you've got some income coming in every month obviously is something that might be a good idea within their financial plan. We've got a question here from one of our attendees. G'day, Ethan. Thanks for the question. What role do financial advisors play for individuals, so salary earners? And at what point do you recommend engaging one? Who wants to volunteer and answer on that one? When should a salary earner think about a financial advisor?
The answer that I would give, Ethan, is anytime you've got a question about what your plan is for the future and you want to actually seek a second opinion, that's the time to start. Financial planning is not about having lumpy cash to invest. It's far from that. It's the conversation we're having today is the foundation of our initial conversation with clients. So really, it's anytime you've got an uncertain pathway, you want to actually get some clarity on that, that's the time to start with a financial planning firm.
Yeah. Ladies, got anything you'd like to add to that?
Yeah, I'd agree with Mitch and just add that it's about thinking about, okay, what are my goals? What am I setting out to achieve here? And, you know, if you're not sure about how to go about that, it's engaging someone to sort of step you through the process so they can really consider, okay, but this is where I want to get to. What are the milestones in between? How can we get you there? What steps we need to take to get you there? And another really good measure of when to see a financial planner would be when you are changing life stages. So say you just got, you know, you're about to get married, or, you know, you're just taking on a new job, or your situation's changing dramatically, or, you know, even just, yeah, and you know, even not necessarily just dramatically, but even just a little bit, and that's a really good time to seek advice. A lot of financial planners will have an initial discussion and a discussion over the phone before you even sort of go down the process, and that really gives people a bit more clarity over what they can expect, and, you know, even if is the right time now. So that's sort of.
Anything you'd add to that to answer Ethan's question, Megan?
Yeah, I think I'd just say that you don't know what you don't know, and to think of a financial advisor as being that person who's, you know, they're specializing in finances. So they know a lot of strategies that you may not have thought of or you haven't discussed or been exposed to. It doesn't necessarily mean that you need to engage them for a long term, but having those initial conversations and just seeing where you're at and if there's something you've forgotten or haven't been aware of. And then some people really need that financial advisor too, from that accountability perspective as well. Sort of like your personal trainer, you know enough to be able to do it, but if you don't have that person sort of prodding you along, you're not going to go hit the gym and get that exercise in. Yeah,
that's right.
I often people expect their accountant to have this conversation with them as well, but many accountants only really focus on that tax return sort of side of things. And so that's why I'd say I think there's actually a lot of value in having a separate relationship to your actual tax accountant, so that you come at it from a different angle, so that you come at it with a different lens. And of course, every financial advisor, every financial planner has different specialties. I mean, even within our team that we have on this webinar here now, there are different specialties within the mix. But nevertheless, personal cash flow is probably that foundation one, isn't it?
Definitely.
Mitch, question for you. There are, and Simone mentioned some unforeseen sort of or big events that sort of happen in life, and of course some of those things are fairly catastrophic events like disability or death, and how that impacts different people. Do you have a view, I suppose, on sort of building cash buffers for those sort of situations, or providing for that through insurance? Or maybe the question should be, which one suits which situation?
Yeah, great question, John. So realistically, first and foremost, regardless of what we're talking about with a client, we understand their cash flow. We understand how long can they live financially without money coming in the front door. Once we understand that relationship with their money, then obviously we can come up with some ideas around, well, you want 3 or 6 months cash buffer, whether it's in an offset account or in a savings account. You just don't want to have thin air, because ultimately the bills are still going to keep coming in. Some of the strategies a lot of people undertake, of course, are using things like income protection to offload that financial risk after a period of time. And so typically speaking, somewhere between 30 and 90 days is most typically what people can afford to live without money coming in. And then we can offload that risk to an insurance company, whether it be through their super fund or through their own direct insurance company. That's going to give them an income stream for as long as they're sick or injured. And as long as the doctor keeps saying, yes, this person needs some time away from work to recover, or indeed if recovery is not probable, then it might continue through till the contract term, which could be through to age 65, right up to retirement.
You mentioned there, I think you said 30 to 60 days sort of lead time before you could potentially get a payment from insurance. And obviously this is linked to the personal cash flow discussion from a limiting risks should something bad happen. Is that 30 to 60 days sort of normal?
It's normal, but the expectation that a lot of people have is very different. You know, some people think they get paid on day 30. It's not always the case. Often it's the case that's when the contract starts, and the first 30 days you've been self-insured, which requires you need to have that to have premium control, so you're not paying exorbitant premiums to an insurance company when you can actually cover yourself. Typically speaking, as an example, a 30-day waiting period would mean that you're getting paid or back paid from day 60 for the last 30 days. You've got somewhere between 2 to 4 months you've got to accommodate your own cash flow before you want to offload that risk. Now, the reason we want to offload the risk is because your employer or you're self-employed doesn't have an endless string. The benefits you might be offered through employment or even self-employment at some point will come to an end if you're not in there working the business.
Yeah. Simone, do you have anything to add to that sort of considerations there?
Yeah, I do. I just, insurance is really important as a buffer, and also we also need to work to have our own as well. Insurance is going to cover us for some items, and that's great. And definitely having that cash buffer up until the point that the premium, until the point that the benefits get paid is, it's an excellent buffer to have. And we also need to make sure that we have our own cash buffer for any unexpected events that we might have. I mean, we've seen a lot of unexpected events over the past year, and it's just bringing to a head exactly that we need to be prepared. So having some money in the bank, making sure that we can afford the mortgage payments. Say one party, one husband or wife, they lose their job, you've got to make sure that there's some money in the bank to be able to cover those things. So having a contingency plan is really important, and really having that cash buffer regardless of what your situation is. I know that it's not always it's not achievable for everyone to just go, okay, yeah, let's just have a cash buffer. Like, I understand that everyone's situation is different. So I think, it comes down to that, understanding, like you were saying, what that break-even point is, John. And then, if a cash buffer is not that achievable for you to work towards straight away, just start looking at it, and then making small steps towards really getting to that point, because when you have that contingency in place, you're in a much better position to deal with anything unexpected that occurs. Yeah.
I mean, we keep coming back to this now, where, how sort of consideration that I think of from a business perspective. But, if understanding the now and understanding the risks, and you deal with that through insurance or by cash buffers and those types of things. What about in setting the goals? And Megan, I might throw to you if you don't mind, because I often find that people don't know what goals to set for themselves. They don't know what is a good goal, what's a bad goal, or whether they're not saving enough or they should be saving more. How would you recommend people going about setting goals?
Well, setting goals is going to be very personal to every person. Everyone's going to have different goals as to what they want to achieve. I guess the starting point would be, especially if you're in a relationship, is to have those conversations first, and try and have some conversations at home as to what it is you want to achieve financially. Most of us start out as a younger person going, we want a good job, we want to be able to save for our house deposit. But then those goals will keep changing. You know, maybe you want to start a family, maybe you want to travel, you know, it's going to be different for everyone. Maybe you like fast cars. It's all about how are you going to achieve those, and what is the priority on those goals as well, and measuring that priority against everything else that you've got to fund in your life as well.
Because they're very time-specific goals typically, aren't they? Like I always think of goals as sort of like a peg in the sand. The peg can be moved, but it's a peg in the sand at that point in time so that you've got some idea of something to work towards. What would you say, Mitch, from a goals perspective? Any advice?
Absolutely. Set the goals today. Fantastic. Expect the unexpected, and stuff happens in life. Sometimes if you're doing, sometimes not. Pivot and then go again. So effectively, don't use a setback as a reason not to continue with your goals or reset your goals. Far too often people get thrown a redundancy and they go, oh, I'm redundant, or I've lost my business. Pivot, sort the situation out and go again and reset your goals. Don't use it as a reason to stop. Yeah,
you sort of need those short-term and long-term goals, don't you? You know, I've always loved, I don't know if anyone's ever done the 100-year life plan sort of thing where you just map out what your 100 years might look like. And it's funny how when you work back, you find these other sort of critical sort of points in time. Yep. Simone, on goals, how do you go about setting goals?
Look, you know, when I think about goal setting, I like to look at what we want to finish off and then work backwards from there. So like you were saying with the 100-year goals, maybe not quite 100 years, you know, I'm not expecting to live that long, but it's a good sort of way to think, okay, what's our end goal, or what's the end game? And then look, okay, what steps do we need to take to get to that end game? And it might just be even the first step. So if we pull it right back to what do we need to do as step one today, that's always a good place to start. And when I think about how to set goals, in financial planning, we like to use SMART goals. I mean, you know, when things are specific, measurable, we know, okay, this is what the goal is. How do we measure it? We know that it's achievable, you know, realistic and time bound, and that's what we're after. And that allows us to really track things, and then, like Mitch said, to pivot when we need to, because inevitably things change. I mean, that's why we see our clients every year, because things change, ideas change, goals change, life does. So we need I
actually think that's really good advice, because a big part of setting the goals is realizing that they're going to change at some point in time. It's like, you know, when I've got a business owner and they're retiring and they're selling their business, they've got this bucket load of cash, and they look at how much they need to live every year. But in the first 10 years, they travel every year. Well, they used to travel every year, and they'd spend a lot more than in the next decade after that. And they start to slow down. They want to be with the grandkids and things. So I think having that discussion must be a great way to sort of start the goals sort of process and realizing the change. If anyone does have any more questions, please pop them on the Q&A, or otherwise you can feel free to reach out to us later. I'm sure all of our experts on the webinar here today would be happy to answer any questions. I want to wrap this up. As I said right at the beginning, I want to keep this really practical today, and we picked personal cash flow as the first topic in our theme of these webinars because we think it's something that people don't do enough of. It's simple, but people need to do more of it. So to wrap up our discussion, I'm going to ask each of you, if you don't mind, with one practical tip or one takeaway that you want to leave the audience with today. And I'm going to start with you first, Megan.
My tip would be, and especially for the business owner, is to try and smooth out that income and not have it be so lumpy. So whether that's being disciplined and only taking, you know, what you need each month instead of taking out big chunks, or only taking big amounts from the business once a year, or even, I think John mentioned it earlier, I love the idea of a business owner building up a passive income stream. I see that reduce their stress levels astronomically, because it just means that regardless of what's going on in their business, that they know that their family is going to be provided for, and that cash, like their personal cash break even, is going to be met.
Good one. Simone, what would your final practical takeaway or tip be?
I would say have a budget and have a buffer. So make the time to put a budget in place, really think about, okay, where is my money going? You know, we can't sort of stress that enough with personal cash flow. It's important to know where the money goes, and work towards having a buffer. It's not always achievable overnight, but you know, if you can take those steps to work towards having a buffer when something happens, inevitably as it does in life, then you have a buffer there ready to assist you with that. So,
good advice. Mitch?
To add to Simone's, if we're on a boat together, our cash flow is our boat. You've got leaks that can happen. Go and find the leaks, don't just look at them. The best way to save money is not to spend money that you don't need to. So find what leaks you got in your boat, your cash flow boat, attend to them, and there's a great way just to save some more money and actually have more for yourself.
Yeah, there's a line I always use with a lot of presentations I do, and that is, it doesn't matter whether you earn 50K or 500K. If you spend more than you earn, you end up in exactly the same position. Now, I'm the accountant on the call here today, but I'm going to leave you with one of my practical tips as well, and that is around the knowing where you are now within your personal situation. I'm seeing a lot of people getting value out of doing a personal balance sheet or a personal net worth statement. A lot of people just have no idea what their actual net worth is on an overall basis. You might see it in one bank's internet banking. You'll see what that adds up to, but just actually pulling it all together, and especially if you are a business owner. Thank you very much today, guys. Thank you everyone attending, but thank you Simone, Megan and Mitch for sharing your insights and your takeaways with us here today. If you would like to discuss any of your own personal cash flow, if you'd like to discuss setting goals, or you need some help working out how to get there, we'd absolutely love to hear from you. You can just call 1300 BDepot or oneplace@businessdepot.com.au to email us, or of course you can reach out to one of these presenters directly at businessdepot.com.au. I remind you of the disclaimer: any advice today is general in nature, and you should always seek advice specific to your circumstances. If you'd like to stay informed of more topics, you'll get an email tomorrow with a copy of the link to the video of this presentation or this webinar to reflect back onto. And keep an eye out at the end of April. Our next topic is going to be about superannuation. Did I get that right, Megan?
Yeah, so we're going to talk about superannuation, some of the changes that we're expecting happening around super caps, and just some planning opportunities that you have leading up to 30 June.
So really good timing at the end of April to start thinking about your super strategy, which obviously is a very time critical nature to it with a 30 June deadline. Once again, thank you. We hope we've taught you something. Maybe we taught you something that you didn't learn at school, and hopefully we'd love to see you again on our next webinar in a couple of weeks' time. Thank you very much, everybody.
Thanks, John.
Thanks, John.